that the team has prepared. Thank you so much.
Okay, and this is Carlos with Regis as well. Thank you all again for joining us. We know this is a big topic now for those of us, or for those of you that have been fortunate enough to receive the PPP. I think the next big question is, how does forgiveness work? And as you see throughout the presentation, unfortunately, there's not a ton of clarity yet. It's getting closer and closer to that date, and at the same time, we're starting to use these funds, and we want to make sure at the end of the day that our loans are forgiven. So I definitely want to thank Carlos and Joe from Zumpano Castro, as well as Bernardo from City National. Definitely very interesting to be able to have a bank's perspective on this, even though I'm sure from their point of view, there also is not a lot of clarity. But we'll do our best to figure this out and to provide as much information as we can. And as more guidance comes out, I can promise you that we will continue to do these and continue our best to answer the questions as clarity comes out. I think the one clarity that there has been is that a lot of companies that maybe feel that they somehow shouldn't have, or they're getting bad PR, are returning these funds. And by the way, they did nothing wrong. All these companies legally applied for this PPP based on the PPP guidelines. But as you've heard in the news, there's been a lot of bad PR for these companies. A lot of people are returning the money. And one of the things that's interesting is that the government, or the SBS, has allowed now until, I believe, May 14th for companies that feel that they should not have gotten these funds to return those funds. But I think there's questions around that. What makes you not have been able? What makes you not have, or what makes us not have been able to get those funds? What makes it wrong? And again, I think there's still a lot of things that are just unanswered even to this day. So again, I appreciate Carlos, Joe, and Bernardo for doing this, even though there's not a lot of clarity. We're going to do our best to provide you with some clarity, but please keep in mind, everybody, that again, it's still very open-ended, and they have not provided clear guidance as to the forgiveness. But once that happens, give us a little bit to digest, and we'll definitely be back. Again, I hope everybody's doing well. I hope your families and yourselves are all safe, and hopefully we'll start seeing things as we are opening up slowly but surely, and hoping for the best that all of our businesses can get back to somewhat normal, whatever that normal looks like. So again, Carlos, Joe, and Bernardo, thank you very much. And without further ado, I'll leave it to the presenters.
Thank you, Carlos, and thank you again, Carlos Rodriguez, George Rodriguez, the entire Regis HR team for another webinar on a fascinating topic. I'm so proud how everybody's being so proactive these days about learning about these programs and acting on it. Today's an important topic. We're going to be talking about Paycheck Protection Program, the loan, and matters of forgiveness concerning the loan. I'm joined today here by my partner, Joseph Ruiz, and we have a special guest this time with Bernardo Adrover from City National Bank, who'll be speaking throughout the presentation concerning the PPP loan and forgiveness matters from a bank's perspective, which is fascinating to have Bernardo's perspective throughout this presentation. So we're thrilled and honored to have him, and again, honored to work with the entire Regis HR team and with all of you today. And I hope that through this presentation, we can answer most, if not all, of your questions and give you an idea of where the forgiveness is going with respect to these PPP loans. And what we tried to do here was a webinar that is very substantive, and it's going to get right at it, get to the meat and potatoes of what the forgiveness program is all about and how do you calculate the forgiveness related issues. And we're about to get into that. But before we do so, I thought it would be a good idea to turn it over to Bernardo for a few seconds, just to let him introduce himself from City National Bank and give us a few global perspectives and statistics that he thinks may be relevant at this time. So Bernardo, I'll turn it over to you for a few minutes.
Thank you, Carlos. My pleasure and honor to represent City National Bank. Some of you guys are our clients, and we deserve to be here to help you out. Basically, what I wanted to share with everyone is the updated statistics for the PPP, the Federal Protection Plan. And I think some of you guys are already aware of the numbers, but on the round two, basically PPP round two so far, $2.2 million, 2.2 million number of loans, totaling 175 billion. This is basically in a week and a couple of days. Again, 2.2 million loans, totaling 175 billion in loan fundings. This is for the entire nation. When you look at the state of Florida, basically for round two, we have 79,000 number of loans for an average of 206,000 compared to the round one of PPP, the averages went down substantially because of the emphasis and focus on lower and small business. So when you look at the state of Florida so far, we have 185,000 loans approved for 12 billion. If you look at the different other states in the nation, we are probably third or fourth in number of loans and in number of fundings. Just California, New York, and Texas being ahead of the state of Florida. So the news are kind of positive from the standpoint of view of a bank like City National. We are probably the second largest bank in the state, and we probably have done about 7,000 to 8,000 applications or loans. We have funded about 2.5 billion in these type of loans. So it's been positive from that area. This second round, again, I can say that we've been doing a lot of smaller business. The average amount of loans for us has been about 140, 150,000. So it tells you more or less the same path that we are following up in the nation. That's what I have, Carlos. Thank you.
That's spectacular. Thank you, Bernardo. It's amazing to see the volume of loans out there, and we thank City National and all the banks for what they're doing, because we understand you're in the trenches getting these loans processed and being very active in this process, not just in issuing the loans, but also in the forgiveness phase, which we'll talk about in a bit as we get towards the end of the webinar. So thank you, Bernardo. Thank you, Regis. Let's get right at it. So Paycheck Protection Program, this is a matter of forgiveness. The focus of this webinar is how do you get these loans forgiven, and what are some of the issues in connection with that analysis. We're going to divide this into 5 parts. A quick overview of the Paycheck Protection Program. Number 2, allowed uses of PPP loan proceeds. Number 3, loan forgiveness and some examples. So we want to get into some practical examples of what might happen to businesses when they actually apply for the forgiveness on these loans. Number 4, I want to turn it back to Bernardo at the end to give a bank's perspective on some important points, some highlight points that we can talk about. And then we're going to open it up to question and answers in the chat room like we've done before. And Bernardo, Joseph, and I will be here to go through those questions and answer them. So let's start with part 1, Paycheck Protection Program and overview. As you all know, the Keeping America Workers Paid and Employed Act was designed to keep the workers from losing their jobs and to maintain small businesses due to the coronavirus pandemic. The economic disaster of the pandemic has been unbelievable. And what this program was meant to do was to help companies retain employees and keep them and weather the storm. As we will get into it, it's an 8-week program to use specific proceeds provided. It enables cash flow assistance through these federally guaranteed loans through the SBA, and it's for employers who maintain their payroll during the coronavirus crisis. So what we'll get into is what happens if you can't maintain your payroll. We'll get into more detail down below. It's provided, as Bernardo has discussed, it's provided hundreds of billions in loans for qualifying small businesses. PPP loans, as discussed, they're available through the SBA. Certified and approved lenders such as City National Bank, credit unions, financial institutions, and other lenders approved by the SBA. These proceeds through these loans are to be used for certain defined expenses during an 8-week period beginning upon the funding of the loan. You'll see this term, and we've done it in prior webinars. It's called the covered period, and you'll see it throughout this webinar. The PP loans can be forgiven in whole or in part, depending on various factors. That's the crux of this webinar. What is and is not forgiven. So let's start with the following. Before getting into the analysis and the formulas and the examples about forgiveness, there's an overarching definition that the Act provided called payroll cost. The payroll cost, you will see throughout this webinar, is important for a variety of reasons, not just on the issuance of the loans, but also for forgiveness. The Act defines payroll costs to include wages, commissions, tips, PTO, including paid sick leave, but not the PTO, the E leave that's provided as a result of the COVID-19. Talking about regular PTO, severance or severance pay, payments for group health benefits, including premiums, payments of retirement benefits. We've talked about 401k matching, payment of state or local tax assessed on compensation of employees. We're not talking about federal taxes. Note, importantly, that payroll costs and compensation payments, what we're talking about are the wages, the commissions, the tips, are capped at $100,000 annualized per employee. You probably realize that when you provided your loan application to the bank, there was a cap on those making over the $100,000 cap. That will become important also in the forgiveness phase. So let's get back. The CARES Act, what were you able, or what are you able to use the payroll cost definition for? Number one, to calculate the loan amount. We use the payroll cost from a prior period. If you will recall, the act said it was the 12-month average of the payroll cost for the 12-month period preceding the loan, the issuance of a loan. Many banks at the end, as a result of further guidance, used 2019 as a measuring stick. So calculation of the loan. Number two, as an allowable use of the loan proceeds for payroll costs during the covered period, during the 8-week period, you could use those loan proceeds for the same categories in the definition of payroll cost. That's a permissible use. And finally, it's used to calculate in part the amount of the loan that may be forgiven for payroll costs during the covered period. So when you use these payroll costs during the covered period, those amounts may be used for purposes of calculating forgivable amounts. So, and you're using the same definition, and we'll get into that in a little bit more detail. Importantly, there's some guidance from the SBA, and they've added further qualification on how to use payroll costs. You cannot use payroll costs for more than 25% of the loan forgiveness amount for purposes of non-payroll costs. We're talking about now going into the allowable uses, the 4 buckets that we've previously spoken about in prior webinars, and we'll get into those 4 buckets now as to the allowable uses and why you can't use more than 25% for the non-payroll costs. All right, before we get into the details and the numbers and the formulas, it's important to understand that there is previous guidance. We are awaiting guidance, and there's previous guidance issued on PPP loans where they've explicitly stated that they will issue guidance on loan forgiveness, and we have yet to receive it. We were hoping to receive that fluid guidance for purposes of this webinar, but it has not yet come out, and unfortunately, as of today, we still don't, it's not been issued, and we don't have an estimate as to when it will be issued. But they did explicitly state they will be issuing more guidance. So at this time, not surprisingly, there remain many questions on how various provisions will be implemented, but we will do our best today to try and get into some of those details and how they're implementing them from a broad brush perspective on what the act says and how we can interpret them, although all subject to change. We recommend reviewing the PPP loan forgiveness calculations with CPA and your counsel, your legal counsel, after guidance is released and prior to submitting the package to the bank. It's important because when you submit your package to the bank, it's the bank that will be determining forgiveness within 60 days of you submitting your application to the bank for forgiveness. So that package is going to be all important. So we're going to go through a lot of the issues today in the guidance, but once that subsequent guidance comes out, it's important to sit down with your counsel and go through it and how it affects you. Now let's talk about the allowed use of PPP loan proceeds. At this time, you've received your loan, and now you're using it during the 8-week covered period. You can only use the loan proceeds for the following costs incurred and payments made during the covered period, which is the 8-week period after the origination of the loan. The allowable uses are as follows, and we're going to get into what I referenced before as 4 buckets. Number 1, payroll costs as defined above. Number 2, you can use the loan proceeds for payment of interest on any covered mortgage obligation, not including any principal. And these are generally for debt incurred on property before February 15th, 2020. Number 3, any payment on any covered rent obligation under a lease in effect before February 15th, 2020. Of course, what the government didn't want was these leases and these obligations popping up last minute. Any covered utility payment, which generally are for utility payments for services which began before February 15th, 2020.
Okay, and this is Joseph. I'm going to jump in here just to let you know that a lot of people have asked if they can use these this money for payments outside of the 8-week period and to cover other things. Right now, you should know the statute says clearly only during the 8-week period from the loan funding. Now, the American Association of CPAs and others have suggested changing that or letting borrowers take the 8-week period. There has been no guidance issued, and they really haven't tipped their hat either way if they're going to accept that kind of guidance but that can change depending on what the guidance is issued. Now, the little guidance that we have put out is they have added one qualification that wasn't in the original statute, and that is that at least 75% of the PPP loan proceeds shall be used for payroll costs. Now, that was kind of a surprise to everybody, but it does create basically an upper amount that you can use for non-payroll costs. Again, those non-payroll costs are what Carlos just talked about: mortgage obligations, rent, and other utilities. So that qualification basically limits your forgiveness amount, because if you don't have enough payroll costs, then you're not going to get forgiven for the full amount.
Right. And now we're going to get into the loan forgiveness and examples. I want Joe to go into some background information on loan forgiveness, and we're going to lead up until a formula at the end. And that formula, we're going to take it and we're going to go through about 5 examples of how the forgiveness matter works. So I'm going to turn over to Joe for now, going through some background on loan forgiveness.
Sure. And so the loan forgiveness portions are limited by a couple factors. I just mentioned one a minute ago, that now at least not more than 25% can be non-payroll costs. That was a standard issued in the guidance later. However, there are standards in the CARE Act that specifically limit what is forgivable for the loan amount. Now, a lot of questions still remain. Again, guidance has not come out on this. The whole world has been basically waiting with bated breath to get this guidance. They have hinted that it's going to come out soon. They haven't given us a deadline. As of a few days ago, they extended the deadline for this to return funds if you don't think you took it correctly. I think Carlos Rodriguez mentioned, the big companies that took the loans. They extended that deadline and said that by basically the 14th, there should be further guidance. Now, they didn't say specifically what guidance or which ones, but we expect something in the next week or so, but it could happen any minute. Frankly, we had to check right before we came in here as to whether or not it come out, and it still has not. So despite that lack of guidance, the CARES Act itself does lay out some things. Now, first off, it does say that basically it's going to limit forgiveness in an amount equal to, the maximum amount is going to be an amount equal to the allowable uses. So effectively, if all your allowable uses, if you only use that loan for allowable uses, that whole amount can be the starting point for forgiveness. Now, we mentioned it's been limited by guidance a little bit, but generally the starting point for forgiveness is if you use all that amount for allowable uses, you're okay, and you're going to start off at 100%.
So let's say you get $200,000 loan, you've used it for those 4 buckets. For purposes of this analysis, you're starting out at $200,000.
Yes. So that would be your maximum forgivable amount. Now, if your amount is less than $200,000, if you could only use $160,000 of those $200,000 for those allowable uses, then your maximum forgiveness amount would be $160,000 in that scenario. Granted, at this point, you're not allowed to use the money for anything else. Guidance may change that, but at this point, you can't even use that money, and it may have to be repaid shortly after the 8-week period. We're not exactly sure how they'll handle basically unfunded portions.
So the issue has come up on multiple occasions where some say, okay, I can't use it for these 4 buckets. Is the recommendation to use that extra $40,000, like in Joe's example, for non-allowable uses? And the answer is no. The government has not given explicit permission to go out there and use that for the non-allowable uses, the 4 buckets that we spoke about.
Okay, so moving along. Now,
we're going to get into 3 types of reductions from when you have your maximum forgivable amount. So let's take the example. You've got $200,000. You've used them for the 4 buckets. Now we're going to get into, before we get to the formula, 3 possible reductions to that $200,000. First reduction.
Okay, the first reduction has to do with what we just talked about in the interim final rule. Again, this did not appear in the CARES Act, but it's this limit that basically not more than 25% of your loan forgiveness amount may be attributable to non-payroll costs. So if you spend a lot more on rent or a lot more on utility payments, and that amount is more than basically 1/3 of what you spent on payroll costs, your amount is automatically going to be capped down. Now, they haven't issued guidance on exactly the calculation they're going to use, but figure that if your payroll costs are less than 75% of the allowable uses, then they're going to bring back and bring down your total forgivable amount so that the forgivable amount, at least 75%, went to payroll costs.
This is a good point. If you've got $200,000 like we spoke about, and you want to get maximum forgiveness on that 200,000, you have to use 150,000 of that for payroll costs that deal with the first bucket, which deals with salaries and tips and wages, etc. You cannot use more than 75,000. If you use less than the 75%, and we'll get into examples, it will bring back your total forgivable amount, and we'll get into that down the road. Second and third reductions.
Okay, so the second and third reductions are in the act itself. They're not from the guidance. The second and third reductions deal with two main things. First is how many employees you employed from a period before compared to how many employees you employed during the 8-week period. And that is a proportional decrease. Now, second, they have a dollar for dollar reduction for anybody whose salary you reduce more than 25%. Now, there's obviously some caps there. If they make more than 100,000, you don't even have to consider them for the second one, although you still consider them for the first, for the number of employees.
Exactly. Now, it's important when we get into it, we'll get into more detail down below in the examples. The second here, the dollar for dollar reduction is when you exceed the 20, if we lower the salary or wages of an employee by more than 25% compared to the full prior quarter. This has been a topic of conversation in a prior webinar. This is that fraction where you have on one side the reduction in number of full-time equivalent employees, and on the other side, reduction in salary. Two components in that fraction that can lower your maximum forgivable amount. Forgiveness in the CARES Act.
Okay, so the second component we talked about there from the CARES Act directly has to do with FTEs, full-time equivalent employees. It's a term not defined in the statute. We assume they're going to use a similar one that is used in the Affordable Care Act. But basically, you're going to come up with a straight fraction. You're going to compare it to a prior period. You have a little bit of leeway as to which period you want to choose. But either way, effectively, if you had 10 employees during your choice period, which is prior to coronavirus, and you end up with 8 employees, what's going to happen is that only 80% of your maximum loan amount can be forgiven. So it is a straight fraction. Same thing applies if you go from 100 to 80 employees. You're losing 20% of your forgivable amount due to that calculation. Now, there are many qualifiers there. There's a lot of questions there. People are asking us if they can basically, if they fire somebody who is making a high wage earner, replace them with somebody making minimum wage. The truth is, we don't have an answer on that. That we would expect in the guidance, but the CARES Act just listed out as a straight numbers proposition. Now, the third part of the forgiveness has to do with reduction in wages. Now, this is another one that they do very broad brush interpretation in the CARES Act. No guidance has been issued. But basically, if you reduce an employee's pay by more than 25%, any dollar more than 25% that you reduce it, you're going to take out from the total forgivable amount. So let's say if you had $100,000 and you know that you went from 10 to 8 employees, you're already down to $80,000 forgivable. Now, if some of those employees, their pay was reduced below or more than 25% to the tune of, let's say, $10,000, you're going to be down another $10,000. So you're going to only be able to forgive $70,000 in that instance.
And we're going to take that visually in an example in a second now.
Yeah, they both work in concert with each other. It's not an either or. Okay, so that is the basic framework there. Now, the regulations have brought out one other thing, one other little quirk. They said that, hey, if you have rehired an employee or restored their pay before June 30th, which, mind you, can be beyond your 8-week period, it will not count against you. Now, that could be a huge thing, because if you laid off many employees and then you brought them back only when the loan proceeds came in, or frankly, even after the 8-week period, according to the CARES Act itself, you don't have that counted against you. So let's say you were at 10 employees, you went down to 8. but on June 29th, you hire back 2 more, basically you're going to be at 100% potential loan forgiveness again.
And this would not surprise us that in this issue, there'll be some more clarity on that, because there is no guidance on timing. Like Joe says, you could fire and then rehire in the last minute just to avoid the reduction in forgiveness. And there's not guidance on whether or not you can and how you can do that. But we expect that to be in the guidance. It's a good point.
Okay, so the guidance, they have actually issued one little detail that talks about basically employees who don't want to come back, that you try to rehire. It specifically states that that they will issue a rule, not that they have, but a fact says that they will issue a rule that excludes laid off workers who you have offered to rehire for the same salary and same number of hours from that reduction amount. So let's say in that example, you had 10 employees, you laid off 2, and you asked those 2 to come back. And you said, hey, you can come back at your full pay and your full hours. And they said, no, I'm making more money through unemployment. I don't want to come back. They will basically exclude those also. So we will still be at 10 employees and therefore 100%. So that is one little thing that they've hinted that they're going to give us, or they explicitly stated that they're going to give us, that should be in the final rule.
Hey, Carlos,
Yes.
Joe, do we
Yes.
have any clarity on what, I'm a little bit confused with what that means. So I laid someone off, and I offered the employment back. I think you guys got a little bit into the documentation of what's required to prove that I tried to offer them their job back.
Right.
Unfortunately, unemployment today pays more than some people make on the regular job. So I understand perhaps why they're not going back. But what happens? Okay, so I've got that. The employee says, no, I've got the right documentation. What do I use that money for? I mean, I'm not going to be able to use it to payroll. I can only use 25% towards other expenses. Does that mean that that money is just mine and it's going to be forgiven, or we don't know that yet?
Well, again, the payroll cost, remember, use it for 3 different things. So you can use payroll cost, you can use it as an allowable use. So that money, however many employees you have, that's the only thing you can use it for, is payroll cost.
Right.
Later on, forgiveness is a separate issue. So under forgiveness, they basically are looking at how much they're going to reduce whatever you did spend in allowable uses. So forgiveness, we go back to that 8 out of 10 example. 10 employees, you laid off 2, but let's say June 29th, you either hire back or you ask the employees to come back at their full salary and wages, and they say no. Effectively, what the government is saying here, and again, this is pending final guidance and a final rule, is that, okay, we'll let you pretend like you still had 10 employees. So you started with 10 and you ended with 10. So we're not going to dock you for that reduction in employees just because they didn't come back.
But if you do reduce your staff and they don't come back, it can still only be used for those 4 buckets, Carlos. So it cannot be used outside of that. And if there's not enough to be used within those 4 buckets, that will get into the analysis that we're going to get into in a second in some of these formulas on what is and is not forgiven and how that can potentially lower the forgiveness, under the actual formulas that we'll get into.
Okay. All right. Sorry. My apologies. I'm being told I'm breaking the rules. We're supposed to ask questions at the end, so I will stop there.
No problem.
Sorry,
All right, so let's recap here. Now we're going to get into some practical examples and get into a formula. So to recap everything, there's a formula based on the CARES Act and guidance. We're going to start with step 1, and then we're going to take it all the way through a summary, and then we'll go into examples. So first, what do? You calculate your total payroll cost expended during the covered period, the 8 weeks, which includes gross compensation paid to employees, capped at $100,000 annual rate per employee. As well as on top of that, you add contributions for health care coverage and like 401k matching, retirement plan contributions, and payment of state and local taxes assessed on employee compensation. That's where you're getting your gross number. You're not deducting for federal income taxes. You're not deducting that. What you're doing is you're getting your gross payroll cost number. Next, during the 8-week period, you're going to calculate your non-payroll costs. Those are the other 3 buckets of the 4. Remember, 1 bucket is payroll cost, and there's 3 other buckets that talks about rent, mortgage, and we talk about utilities. Calculate that amount during the covered period, which consists, as you know, of the interest, rent payments, and utility. Step 2, calculate the maximum allowable amount eligible for forgiveness under the PPP. Divide your calculated payroll cost by 75%. That's where you should start. You're going to see it visually in a second. Let's say you have the $200,000 and you actually used 140,000 of that 200,000. Take the 140,000 and divide that by 0.75. That will give you a number that is lesser than 200,000. That is where you're starting as a maximum allowable forgivable amount, and we'll get into that in a second. So you take your total payroll cost, that bucket, divide it by 75 and calculate 75% of that, divided by 0.75. If the total amount of your payroll cost and non-payroll cost added together exceeds this amount, then you must reduce your non-payroll cost so that when added to your payroll cost, it does not exceed the maximum allowable expense. We'll get into that in an actual formula in a second. So what you want to make sure is that if you don't use your full payroll cost, it will bring down your total maximum allowable amount, which is calculated by dividing your payroll cost by 75%. And that amount is where you're going to get your 75% of payroll of that amount, and the balance of 25% is the maximum you can use for non-payroll costs. And we'll show you visually that. Account for, now we're going to get into those two other issues. Account for the employee reduction. This is the formula. Full-time equivalent employees, average number of FTEs per month during the covered period, divided by either the average number of full-time employees per the FTEs per month from February 15, 2019 through June 30th, 2019. That is the first of the two choice periods. You may recall that concept in a prior webinar. Or the denominator is the average number of full-time employees per month from January 1st, 2020 through February 29th, 2020, whatever benefits you more. That fraction, you multiply it by this percentage with your maximum allowable amount you calculated before in step 2. Next, here's an important issue. This is the FTEE. So in this formula, how do you calculate what is an FTEE? That term has not been defined. However, it is possible that they will use the definition in the Affordable Care Act, where they do define FTEE, and it uses the following formula. Each employee who works 30 plus hours a week counts as one FTEE. For all employees who work less than 30 hours a week, the total of all the hours worked per month by part-time employees and total all those hours and divide that by the total hours worked by 120 hours to find out how many full-time employees your part-times make up. So they allow for this formula as a fractional computation of FTEs. Total those two. So you total your full-time at 30 plus hours, and then you total your part-time under the bullet point, under the formula there, by totaling all the hours worked per month by part-time, dividing it by the total hours worked, and then that by 120 hours. Okay, so that's going to get you a definition of FTE based on the Affordable Care Act, but that has not been solidified, and neither has that been confirmed by the government. It may come out in future guidance. It's also possible that they could put further restrictions on this calculation. For example, it's to avoid rewarding certain businesses that terminate high wage earners and then replace them with minimum wage earners. So you may have scenarios where during that 8-week period, somebody making 90,000 or a group that makes 90,000 is terminated, and then someone else is coming in at 30,000, and that satisfies this is a pure number standpoint, satisfies that fractional of 10 over 10 for full-time equivalent employees. Government may give guidance as to that and how to avoid that type of what they might call excessiveness in the definition of FTEE. Okay. Step 3, pending further clarification, you may be able to include FTEs hired back before June 30th in your calculations of FTEs and possibly after the covered period. This is what Joe had spoken about earlier. Additionally, existing guidance also implies that you may also include some FTEs that have turned down offers to return to work. So this FTEE issue is still in flux. Of course, both of these inclusions would allow you to get a larger forgivable amount, but this remains to be seen. Now we get into the other part of the formula for reduction on the maximum forgivable amount, and that is when you reduce a full-time equivalent employee's total compensation by more than 25% compared to the full prior quarter. This doesn't apply to those making more than 100,000. It's for those employees that are making less than an annual compensation of 100,000 annualized. So you identify their average prior compensation earned in the prior full quarter, and you subtract 25%. Then what you do is, that's the reference amount. You subtract 25% from the prior compensation earned in the full prior quarter. Compare that to the compensation earned during the 8-week covered period so that you get the difference between the two. For every dollar that the reference amount exceeds the average compensation received for the 8-week period during the covered period, you reduce the amount calculated in step 3 above by $1 to obtain the final loan forgiveness amount. So what you do is if you lower their salary by more than the 25%, it's a dollar for dollar reduction on your loan amount. That's the reduction in salary reduction on forgiveness. Step 4, pending further clarification in the expected guidance, you also may be able to disregard reductions in pay for employees whose pay is restored before June 30th, but possibly after the covered period. Another issue that we've touched on already. Again, in this section, it could lead to a larger forgivable amount. So let's recap. And this is the page that I want us to focus on for purposes of simplicity. We've given you a lot of information, but look at these 4 bullet points to calculate your total forgivable amount. You start maximum amount of eligible loan forgiveness, at least 75% of which is payroll cost. If you have $200,000, you must have a payroll cost of $150,000. If you have a $200,000 loan and you only used $140,000 for payroll costs, you divide that number by to get the 75% of that. So it'll be a lower number from $200,000, and we'll show that to you graphically now. Point 2, you multiply that number by the average number of FTEs per month calculated during the covered period, the 8-week, divided by the average number of FTT per month calculated during the choice period.
I don't know that.
Minus that number by any reduction in average salary or wages of any employee during the covered period that is in excess of 25% of the average salary or wages of the employee during the most recent full quarter during which the employee was employed before the covered period. That's it. That equals your total forgivable amount. So this page of the slide is going to be key as we get into some practical examples now. So let's start with an example. We'll go through 5 examples real quick. Example 1, you have a total loan amount of $200,000. Your payroll cost is in the 8-week period is $160,000, right? Your mortgage, rent, and utilities may not exceed the balance of that, the $40,000. So your estimated maximum forgivable amount here is $200,000. Why? Because you used at least 75% of your payroll cost against the $200,000. You follow? So you can use the full maximum forgiveness. Why? The key is you start with payroll cost. Did your payroll cost equal at least or greater than 75% of the amount of the loan? In this example, the answer is yes. And in this example, the FTEs stay the same at 10. During the comparison period, it's the same thing as a reference to the choice period. There's 10. So there's no reduction on that part of the formula. There's no wage decrease beyond 25% zero. Your total forgivable amount is $200,000. Let's go to example 2. This is where it gets interesting. State that and this is an example where you spend less than 75% of the loan on payroll cost. Start with $200,000. Your payroll cost for the 8 weeks was the $140 I had mentioned earlier, less than 75% of the amount of the loan. Divide $140,000 by 0.75. That gives you the 4th bullet point, 186,666.66. That is your estimated maximum forgiveness amount. You get it? So your mortgage, interest, rent, and utilities cannot exceed the balance of 186,666.66 minus the 140,000. Therefore, the amount that you can deduct for mortgage, interest, rent, and utilities is only 46,666.66. You have a full covered period of 10. You have the FTEs during the covered period of 10. During the choice period 10. There's no change on that fraction, and there's no change on a wage decrease. Again, your total forgivable amount in this scenario is 186,666.66. Joe, you want to say something?
Yeah, and you would end up basically with a loan balance of $13,333 that would have to be paid back eventually under the PPP loan terms.
Right. One important point here. Look at mortgage, interest, rent, utilities. You may have spent 60, but look at the parentheses. It exceeds 25% of the forgiveness amount by 13,333. So that portion gets reduced. So it's the 140 plus the 46,666.66. That's the maximum forgivable in that scenario. Let's Move on to example 3. Here, we're going to go through it within how the employee reduction, these are the FTE fractions we went through. Maximum amount of loan, 200,000. Your payroll cost is at least 75%. Great, 160,000. Your mortgage, interest, and rent is the balance of the $200,000 loan. It's capped at 40,000. It cannot exceed 25% of the forgiveness amount. You're left with $200,000 maximum forgivable amount. Let's take the FTEs during the covered period and compare that to the choice period, the comparison period, 10. Okay, here you have a 20% reduction on the FTE component of the fraction. No wage decrease greater than 25%. So you reduce the $200,000 maximum forgivable amount by 20%, which is $40,000. You're left with $160,000, 80% of 200,000.
And you would have a $40,000 loan left over that can be paid back according to the terms of the PPE loan, which right now is 1% over a 2-year period.
Example 4, let's deal now with a wage decrease. $200,000 loan, $160,000 allocated to payroll costs, which is at least the 75% threshold. As discussed, you can't exceed more on the other 3 buckets. You can't do more than 25% of the forgiveness amount. You're left with the full $200,000 as the estimated maximum forgiveness amount. In this case, the FTEs did not change, 10 over 10, no change, no employee pay reduction amount. But there is a decrease in the wages, so the salary. So you decrease the amount across the employees by greater than 25%. Collectively, you calculated at least $10,000. Each employee, when added together, we're making a collective $10,000 less than that. That's $10,000 exceeding a reduction in 25% compared to the full prior quarter. That $10,000 wage decrease amount is reduced dollar for dollar from the $200,000. You're left with $190,000 as your forgiveness amount. Let's move on to example 5. This is where you have an employee reduction and a wage decrease. Start with $200,000. Payroll cost is at least meeting the 75% threshold. Again, you can't exceed more than 25% of the forgiveness amount for the other 3 buckets. You're left with $40,000. Total estimated maximum forgiveness amount is $200,000. Here, you have 8 FTEs during the 8-week period, 10 during the choice comparison period. You have a reduction there of 20%, just on that fraction of the reduction. You also have a wage decrease here of $10,000. So here, what you do is you take the full $200,000 maximum forgiveness amount, you multiply it by 0.8 because you have a 20% reduction. You reduce it by 20%. That leaves you $160,000. And you also reduce that $160,000 by $10,000 wage decrease amount, which is the second part of the formula, the minus. Okay, so you're left with a total forgivable amount of $150,000.
And the balance of the $50,000 would be what's left on the loan, and again, payable over time under the PPP loan terms.
We're sure you have various questions, and we'll get into that in the chat room in a second. But I'm going to turn it over now to Bernardo, and I want Bernardo to talk about the bank's perspective on a lot of what we're talking about here with respect to the forgiveness component of these PPP loans, and anything else that Bernardo feels important to discuss today. So Bernardo, Joe and I are going to turn it back over to you to discuss a bank's perspective.
Thank you, Carlos and Joe. You guys did a really good explanation of what the forgiveness is. Again, as a bank, what we look for is documentation. We look for, basically, when you look at the documentation side for forgiveness, I mean, the same thing that we asked when the application was initiated. We usually look for 940 forms, 941s. More important, the payroll summary report for the forgiveness period in 2020. We're usually going to be looking also at corresponding bank statements for that particular period. It's also important to know that sometimes we're going to be looking for, I mean, in that 8-week period, if you have any vacation, you have any allowances in group healthcare benefits, retirement benefits, etc., anything that can prove to the bank and to the government that that forgiveness is going to be effective. The most important thing is having payroll records. So to have a really good payroll company is extremely important for those businesses. The receipt is extremely important as well. That's what I mentioned prior. And then when it comes to the bank perspective and guidance, it's going to be based on all that. It's going to be documented, but ultimately it's going to depend on the SBA guidance. The SBA is under a lot of pressure to kind of really do this well. It's been under a lot of criticism in the beginning rounds. I think he's reacting and he's doing a better job. One of the things that just happened today, they extended the moratorium on the safe harbor that was basically affected. The deadline was today until next week for those companies that wanted to return the money. So that was extended another week. So that basically tells you how flexible they've been going about doing this forgiveness period. It's going to go back to us, but it's going to go back to the SBA for full guidance. I mean, it's going to be dependent on them, on the SOPs that they are issuing daily, maybe one or twice a day, for us to kind of make that determination. That's what I have as far as go.
Great. Thank you so much, Bernardo. I really appreciate it. That was great. George and Carlos, we are done with the main presentation. We're going to turn it over to you all to see if you'd like us to just run right into the chat room and go through questions, or if you'd rather say a few comments before we go ahead and do so.
No, I think it's okay to definitely go a few questions. I definitely want to try to, limit the time here, as I know people got a million things. And what we can say is that if whatever questions we don't get to, we'll definitely make sure that we answer those questions in the next couple of days and get them out to you guys ASAP. Again, I just want to make it clear that we are still pending a ton of guidance as to this forgiveness component. So it's, I'm cautious always to answer a lot of these questions without more clarity from the government. But let's go ahead and try to answer as many as we can, gentlemen, if you don't mind.
No, absolutely.
Then at 3 o'clock, 3:05, we'll try to just close it out and then, answer the rest of the questions, via email or put them on our COVID-19 Regis webpage.
You got it. So let's go to the chat room right now, and we'll go through these questions and tackle them one by one. First question: is the part forgiven taxed? Is there any documentation on the exact interest rate for the part not forgiven? Bernardo, if you want to take this one, I'll be glad to answer it unless you want to take this one.
Which one is the one on the keep employees?
Yep, this is the one that says, is the part forgiven taxed? Is there any documentation on the exact interest rate for the part not forgiven? The only reason I turn it to you is I understand from a bank loan perspective, you all will be charging the required interest rate under the PPP.
Yeah, the bank will charge for the remaining unforgiven portion, the 1%. But
right.
You're going to have a deferral of about 6 months to be able to make that payment to. So that will be flexible in terms of that particular business. What we've been seeing in some cases, I've seen some businesses, smaller businesses, restaurants, and smaller businesses that they really look at it as some capital investment into the company for the time being, and they are even willing to pay, not to get the loan forgiven and pay that 1% in the 10-year period. I've been getting comments from some of the businesses out there telling me, Bernie, I'll probably be able to get the full amount forgiven. I don't mind getting a $40,000 or $50,000 loan at the lower interest rate.
No, yeah, I've heard that as well. Bernardo, by the way, it's very, I don't know if you're on a speakerphone. It's very hard to hear you. Just FYI, if there's a way you can get on a regular phone, that'd be great. But yeah, we've heard the same thing. Definitely, clients saying, "Hey, I'm just going to use this as a very cheap loan." Again, I'm hesitant only because I don't know what the SBA can change in the last minute and whether we're going to be able to do that. But I agree. We've heard the same thing.
All right, and we'll repeat it. The interest rate that Bernardo was discussing was the 1%. And as to the other part of the question, is the part forgiven tax? Joe wanted to answer that, so go ahead.
Yeah, very quickly, the IRS has made clear that the giving of the granting of the loan is not going to be taxed. It's not going to be a taxable event for the company. But curiously, the IRS issued guidance that basically saying you cannot deduct the payroll costs that you use for the forgiven proceeds. Now that kind of went in the face of most of the legislatures. They've already actually are trying to propose a bill to make it clear that no, they want the companies to also benefit from the deduction for those salaries and the 4 buckets that they paid out. But as of right now, the IRS said that yes, you're not going to be taxed on it, but you also can't take the deduction for the salaries and things that you normally would. Again, that was kind of went the other way of what everybody was expecting, and they're trying to propose legislation to correct that. But as of this one moment, I talked to your CPA about this, but the IRS has said that yes, it is tax-free, but you can't also expense the payroll and whatever you use those expenses for.
Yep. Okay, that answers that. Next one, are life insurance premiums for employees considered a forgivable payroll cost? That is not a category in the CARES Act under the definition of payroll costs. Let's go to the next one. For purposes of calculating the FTEs during the 8-week covered period, is it an average of the FTEs for your various pay periods during those 8 weeks, or is it just your final payroll? Very, very good question. We would not be surprised it's during the entire week. You have companies right now that have a scenario where during the 8-week period, they have 10 employees, but one of them is only there for 4 or 5 weeks of the 8-week period, and they replace that employee during, so that it's continuous for the 8-week period. It would not surprise us that it is the average of FTEE employees during the 8-week period. The question that's going to happen is, it's even though we know that based on the clear reading, it's not tied to the per employee. You can replace an employee. If there's a time gap, there's no guidance as to what happens when there's a time gap. For instance, you have 9 employees for the 8 weeks. You have 1 employee for 4, and you replace that employee for only 2 weeks. So that we hope that there's more guidance on that, but it does appear that the average appears to be where they're likely to head on that, based on a plain reading of the CARES Act. Next question, if an employee makes $150,000 per year, $2,885 per week, should I pay them from 2 different accounts? $1,923 per week, equivalent to $100,000 from the PPP funds, and $962, the balance from our regular payroll funds. There is no prohibition from you paying them from 2 separate bank accounts. It's a matter of accounting. This is an excellent question, and I'm glad to have Bernardo here, because even though there's no prohibition, because what the act says is you just can't go above the annualized 100,000, but it doesn't give you a mechanism from internally how to document it. So there is no prohibition from having 2 separate accounts and doing 2 separate checks to the employee for tracking purposes. Bernardo, I'd like to see from your perspective, from a bank's perspective, is it something that you're going to be reviewing these loans for forgiveness purposes? The banks will. Is it make sense for them to have 2 separate payroll, 2 different accounts, and process payroll from 2 different accounts from a bank's perspective?
Carlos, I would say yes, you can have 2 different accounts. The key issue here will be for government purposes, you're going to have the 100,000 limitation. When you're going to get that loan to be forgiven, it's going to be to 100,000. So you have the cap
Right
at 100,000.
Great. Yep. Okay, makes sense.
So, yeah, you can have 2 different accounts for that.
Okay, great. Thank you.
Let me answer that. Let me answer that as well. My CFO and I had the same question that Agustin just asked. Definitely your PPP loan money should be in a completely separate account. I think that's been a recommendation from day one. I think we've decided that we're just going to pay out the payroll. We're just going to keep our payroll records the same and then split it out later. So I think you can do it either way. Either pay it out like Agustin just asked, pay it out of 2 different accounts. We're just going to pay it out, and then we'll balance it out later. But I think it's just a matter of how you do it. There's been no clarity on that, but I think as long as at the end of the day you take out that additional 50, I think you should be fine.
Yep.
Okay, great. Moving on to the next question. How are the 8 weeks calculated? From day of funding or from week of funding? It's from the date of funding.
Now, the American
I'm sorry,
Institute,
Bernie, did you say something?
Correct. Day of funding.
Okay, correct. Yeah. Go
yeah,
ahead.
the American Institute of CPAs has recommended to be able to shift that date, but textually in the act itself, it does say from basically the day it's funded. So we don't know if they can move it, but I'm sure they would consider it.
Okay, great. Next question. We added employees during the covered period. Does that change anything? For purposes of giving you additional, it does not. It only helps if you terminate employees, FTEs during that period, or they resign. If your numerator gets a lot larger than your denominator, in other words, you have more employees, more FTEs during the covered period compared to one of the choice period, you don't get the added benefit as a result of that. It's only a reduction in the maximum forgivable amount, not an increase. So what you got to make sure there is as long as your numerator is greater than your denominator, that's a good thing. If your numerator is lower than the denominator, which means you're losing employees or terminating or having employees resign, then the numerator being lower than the denominator will reduce your maximum forgivable amount. Okay, next one. What about 1099 expenses? For purposes of the payroll cost, for purposes of forgiveness, 1099 expenses are not for independent contractors are not included in the 4 buckets. But remember, you can still expense the utilities, the interest, and the 4 buckets for purposes of having a forgivable amount. But 1099 contractors are not explicitly provided for as a payroll cost. The next question, Carlos Rodriguez, I'll turn that over to you. You can answer this now or later if you please. I think that deals with a special report.
Yeah, I see that from, can Regis calculate the amount for each payroll process that is applicable to the PPP? And we stayed away, guys, last time from calculating stuff. ADP got into, I shouldn't mention ADP, but when a company, ADP, got in trouble for sending out calculations that later were incorrect. Right now, I'm hesitant to do that. I'm not going to lie to you. If anything I see that comes out that I feel a little more comfortable doing, we will. At the end of the day, guys, I think this is really something that we will provide whatever report you need, but I would definitely recommend that you sit down with your CPA when it's time for the forgiveness and kind of go through that and both your CPA and your legal counsel and go through that and work out the details. I promise you that we will provide any report that we can to help you clarify those numbers, and I believe we will be able to do that. If there's a report out there that comes up that I feel comfortable providing, I will, I promise. But as of right now, that we don't have anything set as to, besides our normal regular payroll reports that we're going to provide.
Thank you, Carlos. Can the PPP funding be used for back pay or accrued payroll prior to the funding and still be forgivable? I'd love to hear Bernardo's perspective on this. From our perspective, what we're hearing is that it's for the 8-week period, and consistency is important, whether it's on the accrual or the cash basis. Some questions arise, for instance, if you have a payroll on May 10th, let's say, or May 9th, and you and that incorporates a week or 10 days or a part of the prior period prior to your funding, can that be part of the forgiveness? The recommendation that we're hearing out there is be consistent. If you're going to use the May 9th, the May 10th payroll period, only do 3 more payrolls. Don't try and fudge the numbers so you go beyond the 8-week period on the payroll. It's an 8-week payroll period. Otherwise, you could do it, accrual versus cash. You can also set it up where you're actually only tracking payments made and funding it based on the 8 weeks exactly post-funding, so that you start a payroll right on the day you receive the funding and you do it just for 8 weeks and you end on the last day. If you do it the other fashion, which is where you get a little bit of the pre-salaries of your employees prior to funding, you'll end up on the back end not getting the full 8 weeks, but it'll still be consistent. It'll be 8 weeks, you follow? So I think in the end, consistency is key. Accrual versus cash, I don't think you should be mixing them and playing with them. Some prefer to do it, to just do it based on the 8 weeks beginning on your funding. But a lot of people say practically it's hard to satisfy that. Bernardo, do you have any thoughts as to that?
Yeah, it will be the same thing. I think the discussion of the 8-week period, but you need to follow through. I will probably err in the form of caution and be conservative. Don't try to really push it. Most of the banks are going to probably be really conservative in that end. They're gonna try to stick to that. And if you're gonna make a change on that, you have to really have a little documentation or evidence that you've been doing that before.
Thank you. Okay, next question. For rent, we had rent due on April 1st. We got our funding later in the month. Is it considered for forgiveness? Very, very good question. I've had a discussion with a CPA about this, and I got interesting perspectives on this. There's a 75% minimum threshold for payroll costs limited to the 8-week period, like Bernardo just stated. The 8-week period is key. Don't go beyond that. However, there are some, if you get funding, let's say on April 15th, and your rent is due at any time that month, the question, you haven't paid rent, the question becomes, can you do 3 rental payments? which is April, May, and June, because you have 8-week periods. So the issue becomes whether or not you're capped at the 8 weeks for some of the non-payroll costs. Payroll costs clearly are 8 weeks. Some CPAs are saying that you can do 3 months of rent in those buckets. However, that remains to be answered by the guidance and be answered by the government. However, if your rent was due prior to you getting the loan and it was due then we recommend against using the proceeds for a prior month's rent. It needs to be during the 8-week period. The problem that the government has is they haven't given clarity on non-payroll costs, because you might have 3 months where conceptually you could use those non-payroll costs during those 3 months. And that remains to be seen. But the conservative approach is 8 weeks. Apply it for during the 8-week period and the amounts, and consult with your CPA and counsel once the guidance comes out. But definitely if it's a prior due amount, it doesn't appear to qualify for purposes of using the amounts of money for forgiveness purposes. Okay, for calculating wages towards the 75%, would the number be capped at 100,000 inclusive of retirement benefits, or would the calculation be 8,333 plus retirement contribution plus? It's plus. So it's the annualized $100,000, but you add on top of that your healthcare matching as well as your 401k matching, for instance. So it's on top of that. The $100,000 is limited to the compensation portion, such as salary, wages, bonuses, tips, and things of that nature. Could Regis, okay, that's something that Carlos already addressed. How would a sole proprietor with no payroll show contributions towards salary? A check, wire, transfer from the company account to the owner's account? Great question. Obviously, as you know, the CARES Act specifically and the guidance does allow for sole proprietors and 1099s to actually apply for the loans and receive them. We suspect that from a documentation standpoint, it'll just be, the banks will likely be looking for clarity as to that you're paying yourself a distribution or some type of pattern that shows that you're paying yourself a salary or distribution in accordance with what you customarily have done. So Bernie, I guess it's a great question for you. For those that are in sole proprietors or 1099s, those that may not be on payroll as you would in a typical employment setting, has the banks yet formalized what they're going to be looking for from sole proprietors to substantiate the payroll cost portion?
Oh yeah, actually, it's a really good question, because just today, I think before we started the webinar, we had the SBA exercising some guidance into the 1099s and self-employed people, because there were a lot of questions on that. A lot of the banks were hesitant in trying to help that segment of the small business community, because the guidance that we had was really not that firm, that black and white, and we were struggling in consideration with some of these loans. But today they affected that. If you want, what we can do is let me see if I can get a hold of the SOP from the SBA, and I will send it back to you guys, so we can make further clarification on that. But that's a really good.
But the answer to the question is clearly also to supplement what Bernardo's saying is clearly the government is expecting sole proprietors and 1099s to be able to benefit from this program. If we give a payroll bonus to employees during the covered period, is that forgivable? Great question. My colleagues and the chatter out there amongst attorneys that we've been dealing with on this issue, the answer that we've come up with, because there is little guidance, but the recommendations that we have heard and that we agree with is that should not do anything out of the ordinary. Some people were thinking, well, if I have an employee making $30,000 and I have $50,000 left, can I just give that employee the $50,000 bonus and count it forgivable? There's not much guidance out there. However, there is a lot of chatter that you should do what ordinarily in the course of what you normally do. You should stick to what you ordinarily could do on from a reasonable basis standpoint, and not try and play around with this to try and just fudge it so that we get the maximum forgiveness at the expense of what is ordinarily done. Having said that, there is not a lot of guidance on that, but there is a lot of chatter in the legal community about doing what ordinarily should be done in your ordinary course.
Yeah, and remember, you're still limited to the $100,000 in compensation that you can pay back, and that's average. That's not a gross amount. So basically, $100,000 annualized over the 8-week period is going to be your upper limit of what you can use that money for, regardless. So you can't basically cross that line what would be an annualized more than $100,000 either way.
Great. Next question. Each of our payroll periods includes wages for some highly compensated employees that make more than $100,000 annually, as well as wages for those employees who make less than $100,000. How does that scenario affect loan forgiveness? For purposes of calculating the loan forgiveness, you got to cap it at $100,000. You can add on matching for health insurance, matching for 401k, but you have to cap the $100,000 annually from an annualized basis. You cannot get forgiven any excess above the $100,000 per employee.
And as far as the FTEE calculation, that is the same whether or not they make less than 100 or more than 100. That does not change. So it does not change your forgiveness amount just because you have some highly compensated employees and some that make less. But remember, each employee is capped at $100,000 in compensation. So if you have all employees that are over 100,000, your maximum per employee compensation is 100,000, again, annualized.
Great. Next question. The SBA keeps changing the meaning of the certification that you need to provide about your financial situation and the need for this loan, and is suggesting that you may need to prove your situation was such that without this loan, your company may not survive. Very, very, very good question. I have some thoughts and I'll turn it over to Joe.
Yeah, the SBA and the government just issued a fact on this. I believe yesterday they extended a time period that it was due. Previously it had been May 7th. So previously it had been due today that you would have to repay your loan in full if you couldn't make the following certification. Now they targeted this exact certification. They said, if the certification that says current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. Basically, they're saying that you need this money to continue to survive. The guidance specifically said, hey, if you are a large public company with access to credit markets, you shouldn't have made that certification. Now, they don't go much farther than that. In fact, they even leave open some wiggle room there that even if you were a public company, you could still do it. But either way, they basically said, if you cannot make that certification, now they've already said they're going to audit anything over $2 million. So they're going to look at this. We don't know exactly what parameters they're going to use. The only thing that they've laid out so far is that if you're a large public company with access to capital markets, maybe you don't need this. Now, they extended the deadline to pay back. From yesterday, they extended it to May 14th at this point.
Right.
To pay back the loan in full, and then they don't even look at whether or not that certification was true. So you have a little bit more time to consider that. But again, that is only if you're going to pay back the loan in full. And that basically lets them ignore that you made that certification in the first place, and they won't consider it fraud. They still don't tell us exactly what analysis they're going to use, how they're going to go into that. The only thing we know for sure is that they don't think that people who are large public companies with access to credit markets would fit into that definition.
Right, and that just came out yesterday, so May 14th is the new deadline. And I think a lot of people did these loans anticipating this downturn in the economy, and everybody did it. Many companies did it in good faith, anticipating that this downturn in the economy is affecting the bottom line and the ability to continue to operate in the ordinary course. So yesterday's guidance is a bit more guidance, which is helpful. And I think we'll see hopefully more coming from the government on this. And just to add, I think Joe touched on it, the audit that they're looking at right now, they can audit anybody, but they did mention the threshold of 2 million. It will come down to how strongly are they going to go ahead and enforce these provisions or not. And I think a lot of that remains to be seen, but yesterday's guidance was quite helpful.
Yep.
Is anything affected in calculation of the forgiveness based on any existing cash reserves in our accounts on the day of the PPP funding, or any new cash deposits revenue after the day of the PPP funding? The answer is no. What you recover during the 8-week period, you're allowed to continue to operate in your ordinary course and have cash, have reserves, and so forth. What they're looking at is how you spent this money. And did you spend it within the 4 buckets, regardless of whether or not you actually were able to bring in additional revenue? Aside from the prior topic as to whether or not you need it, even if you're a legitimate borrower and you do receive cash and there's cash reserves in your account, that doesn't affect your PPP funding or any new cash deposits after you've been approved for your loan. What matters is how you spent the money during that 8-week period.
Yeah, they don't put any restrictions on how much money you can make during the 8-week period. Frankly, they would prefer that you keep on making money and keep on, stimulating the economy during that 8-week period. So there is no restrictions on, for example, the amount of money you can bring in or the amount of cash that you have on hand.
So next question, are we penalized if an employee resigns during the 8-week period? Great question. We touched on that during the presentation, and that was, the answer is you could be. If an employee resigns, it will lower that part of your fraction on the FTEE. It could lower your numerator compared to your denominator, and it could affect your overall forgiveness if they resign. The good news is it is possible, and we're waiting for guidance on specifics, that you can rehire and help offset that. So we're just waiting for guidance as to how mechanically that could work. I noticed on the slide indicated interest mortgage on property. Is the interest paid on a business line of credit an allowable expense for the PPP?
And the answer is yes, we believe so. It is mortgage, it is real or personal property. So yes, the loan interest only, remember, not principal, can be deductible.
Next question, how will a borrower challenge a decision that the loan is not fully forgiven? Excellent question. And again, I'm so proud we have Bernardo on the call. What will happen is after the 8 weeks is over, you will be in a position where you will apply to the bank for forgiveness, and the bank will review your file within 60 days. So Bernardo, I know that you all have quite a bit of discretion. Is this still at the early stages, or have the banks provided an appeals process internally yet for this scenario?
So we are basically on the internal process and understanding well the forgiveness. I mean, a lot of the questions that you guys have had here are really good questions. I will tell you that right now we have meetings, internal meetings with the risk, our credit department, and the SBA as to the different interpretations similar to what we do here. And we haven't come up with a full answer to some of these. But I mean, in this particular question, it's going to go back to documentation. I mean, the borrower is going to have the right to document and prove to the bank and the SBA that the loan could be forgiven. If they can provide the right documentation, the right information, we'll take it and we'll appeal it and process it and get it done.
Great. And the important thing also is that the CARES Act have given the banks, they're the administrator, which is going to be quite interesting, because what the SBA has done is empowering the banks to not only deal with the loan application, but also the forgiveness phase in that 60-day period. It's not surprising that we live in a country where there's due process, that there'll be an opportunity there to respond at least and explain yourself. Would not be surprising to us, but the banks have quite a bit of discretion under the CARES Act. Next question, are we penalized if a part-time employee requested some time off, unpaid, back in March to finish college semester? Well, remember, you're only allowed the analysis of the payments, the compensation, and the FTEE is during the 8-week period compared to one of the choice periods. But prior decisions concerning compensation prior to you getting the loan is irrelevant for purposes of obtaining the loan amount and the calculation of the forgiveness amount. What is relevant is whether or not that employee was counted for purposes of one of the 2 choice periods we went through in the presentation, and whether or not that employee, if it was counted, then it might affect you for purposes of your denominator in the actual reduction formula. For purposes of payment, are they currently employed now? And if they are currently employed, are they being reduced now by more than 25%? And how does that affect the second part of the formula? So for purposes of the reduction in forgiveness, what they're looking at is comparing the FTEE now, the 8-week period, to one of the choice periods, and whether or not an employee that's existing now has had their pay reduced by more than 25% compared to the full prior quarter. Does worker compensation?
Carlos?
Yep.
Hey, Carlos, I just wanted to interrupt real quick. We've got probably about 10 to 15 questions left. I think it's best, given time and how long we've been on, an hour and 15 minutes. I know several people, just have things to do, and we got to get this. We've gone ahead and copy and pasted all the remaining questions. We will get back to each of you individually on a case-by-case basis and answer those questions, or what we can do as well, which actually might be better, because I realize now that I don't have necessarily the best way to communicate with some of the questions, is we will prepare a Q&A document with the remaining questions, and I will get on our website next to the presentation. and that'll probably be the most effective way to do that. Thank you all for your time. I really appreciate everybody joining this presentation. I think it was very informative. We will also have available for download on our website a comprehensive HR guide, which is available on our website as well. And if you download the presentation, yep, that's the image of the guide. If you download the presentation from the webinar section of our COVID-19 response page, you'll have a link to that guide as well. So again, thank you everybody for your time. And unfortunately, it was a lot more questions than we expected. We are considering doing another webinar that is strictly a Q&A session, open forum type of thing in the next couple of weeks. So we will keep you posted on that.
Thank you, George and Carlos and the entire Regis HR team. It's been an honor. And thank you, Bernardo. It's been great working with you, and we wish you all the very best during these trying times.
Thank you all very much. We appreciate it.
Take care. Bye-bye.